the Fed put is much lower than it was at any other time since 1987. And that means the market could easily go down 30 to 50% before, Powell comes and says, hey, guess what? There's nothing else we can do but live with intractable and maybe hyperinflation. So here we go.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with money manager Michael Pento. If you haven't yet watched part 1 of this discussion with Michael, in which he predicts we're headed into the worst investing environment of our lifetimes, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes I discuss with Michael and our advisor partners at New Harbor Financial in this video. And be sure to stick around for the second half of this video, where we go deep into key topics driving the markets this week, including the strengthening US dollar, gold's continued rise, and whether now is the time to start shorting junk bonds. All right, let's get started watching part 2 of our interview with Michael Pento. Let's make the pivot from, okay, we see this horrible macro situation coming ahead of us. Michael Pento, what should today's investors be considering based upon the lens that you look through? If they want to avoid that pain that you're saying you want to avoid too.
Listen, so for the past 6 years, I've had this inflation, deflation, and economic cycle model. It has 20 components, 10 for inflation, deflation dynamic, 10 for growth, recession dynamic. That performance is available for anyone who wants to find it. It's third-party tracked. I'll send it to you. You could see how we did in 2020 in the first quarter, how we're doing this year compared to everybody else. Again, that balanced portfolio is getting killed. And the worst part of your balanced portfolio has been bonds. Now, having said that, I have been scaling into both short and long-term duration bonds over the past few weeks, in anticipation of finally this inflation print being the highest year over year that we will see for at least some time. And we could talk about what happens in 23 and 24, but we don't want to talk about that now. We're talking about what to own at the current juncture, not what you want to earn years from now. Now, I can make a very cogent argument that we are going to have stagflation like we've never seen before when the Fed and the Treasury sing kumbaya, and there's massive, multiple record trillion-dollar monetization of universal basic income to pull the housing market out of a nosedive, to pull the stock market out of a nosedive, to pull the credit markets out of a nosedive. That could happen, and that would lead to stagflation, and I wouldn't want to go near a bond. But right now, what I own in the portfolio, which is working very well for us, is I own gold, a record amount of gold and gold-related investments. In other words, physical gold and the miners. I have bond and bond proxies. What's a bond proxy, Mr. Pento? Utilities are a bond proxy. Walmart acts like a bond proxy. We own shorts. We are short the junk bond market. And again, we own both long duration bonds and short duration bonds. And it's that.
Hey, Michael, I'm sorry, when you say long duration and short duration bonds, are you talking a mixture of different types of bonds? Are you talking just US Treasuries themselves?
Only US Treasuries, short duration 1 to 3 years, and long duration. So think 20 years plus out of the yield curve. Now that's a much smaller position than the shorter duration, because I just don't think the Fed can raise rates 9 times this year. So if you look at short duration bonds, they priced in already, this is part of the consumer's pain, they priced in 9 rate hikes in 2022. I believe, my bet is the odds are very high that the Fed never gets near 9 times. As I said at the start of this list of horrors, right?
Parade of horribles.
Parade of horribles is that the yield curve has inverted after one lousy, measly 25 basis point rate hike. It normally takes 300 basis points. And after that 300 basis point rate hike occurs, it's only 100 more basis points. So think 425 basis point rate hikes before the Fed says, uncle, surprise uncle, says, I can't do this anymore. The economy is so weak and the stock market is so weak that I now have to switch. Well, they're going to do 100 basis points by June or July. And there's no way that the Fed is going to stop by then. They're going to stop before they get 9 rate hikes, but 2 more rate hikes, 4 more rate hikes? No.
So sorry to put the pressure on you, right? But yeah, you're saying, okay, Fed's going to be much more aggressive than most folks realize, but they're not going to get all the way to 9 this year. So where do you kind of peg it? Where do you think they're eject?
Okay, so let's go through the litany since you asked me. So it took a 6, I think it was 6.25% Fed funds rate in 2000 to break the economy. It took a 5.25% rate hike to break the economy in 2006, 2007. It took a 2.5% Fed funds rate to break the economy and the credit markets. Hey, Adam, here, I'll do my impression of Joe Biden. In 2018, this was long before, forgive me for that impression. In 2018, the point here is that it was long before COVID. The Fed reached their ceiling in 2018. They said, oh boy, let's raise rates from 2.5% to 3.25%. Remember, I don't know if you remember this, but that was the threat from Jerome Powell. We're going above our star. It's actually comical.
Yeah. And never got
there. Knows what the neutral level of Fed funds rate is, So our star 50 points higher, stock market falls apart in the fall of 2018. Russell drops 25%, 30%. So they say, oh, no more rate hikes, but we'll continue watching the paint dry on QT. Well, again, by 2019, the fall of 2019, that had us. In fact, they stopped QT in July of 2019 because that wasn't working out too well for them either. This current QT is going to be 2 times greater than the previous peak of quantitative tightening. 2-fold. Okay. So they're not going to get very far. That's your question, I believe, if I remember correctly. They are not going to get very far. I believe that maybe 1.5% is my best guess.
Okay, so about a 1.5% in the Fed's fund rate. That's what you kind of think.
So the question should arise, Mr. Pento, why is it that the threshold of the Fed funds rate continues to decrease to the point where it would break the economy? The apogee of debt, total non-financial debt, in the year 2007, total non-financial debt was $33.5 trillion, about 220% of GDP. That has now skyrocketed to over $63 trillion, 270% of GDP. And if you look at total debt, including bank debt, it's over $80 trillion. So the simple reason why the threshold where things falter keeps on reducing is because the amount of debt in the system continues to increase exponentially. That is the reason why.
All right. So, I mean, in many ways, we could characterize where we are in the macro story here, kind of worldwide for the global economy, is too much debt, right? And that is sort of summarizing the trend of many, many decades and bad policy and whatnot. And we're at the point where that debt may no longer be serviceable given the rollover into growth evaporating and us falling potentially into global recession here. And so reason why I'm harping on this is there are a number of people, including an interview I just did recently with Simon Hunt, where he basically said, I think we're at the point where that can that has been kicked decade after decade after decade by the central planners is not going to be able to be kicked any further down the road. And this is going to be the moment where the bad debts are going to have to clear the system. And it's going to be really painful for a lot of people. The good news is that maybe by having some of that, a lot of that bad debt clear out, a lot of that malinvestment clear out, it provides us the opportunity to start from a more sane baseline going forward. You don't have to share that opinion, but if we're going from this current inflationary, worry we have right now, where market, asset prices are still kind of, nearish all-time highs, do you see us going into, a bad bear market, but then kind of, cycling out of that again? Or do you see this as being, you used the term earlier, the worst bear market in our lifetimes. Do you sort of see this as sort of the definitive clearing event of all that bad malinvestment that's been building up over the decades?
My visceral response to that is looking back at how important asset prices are to an economy. So if you look back in the year 2000, the total market cap of equities as a percentage of the underlying economy was about 145, 143% to be exact. So fast forward to 2007, it was only a little bit over 100% of GDP. In my last interview in January, it shot up to 210% of GDP. And now it's only down to about 185, 186% of GDP. Still about 40 percentage points higher than it was in the great NASDAQ bubble in the year 2000. So the question I asked myself, can you actually have this grand debt jubilee or reconciliation of asset prices without a depression like we've never seen before? And the answer is probably, most likely, almost most definitely no. And then what is the risk tolerance for those in charge to allow that healing process to consummate? And I think that tolerance is very low. So I would agree with that person that that's the gravitational forces of deflation, that cathartic rebalancing that needs to take place will start to happen, but is it allowed to do its job? I would say probably, given that the asset value as representative of the economy has risen to such a high level, it can't do it in isolation. Like in 1987, when we had that 23% down day, it was barely a hiccup in the economy, because Greenspan reliquefied the system. Inflation wasn't a salient issue back then, and total market cap of GDP wasn't anywhere near where it is today.
Right.
I think it was like below 50% back then. So you cannot have a grand, cathartic, necessary reconciliation of asset prices without engendering a depression. And I don't think that's a politically tenable position for anybody in power.
Okay. I'm just going to restate what you said. Correct me if I'm wrong, but you say, look, that's what the forces of reality want, right? They want that. They want that clearing event. They if left alone, the markets would just deflate to get rid of all that bad debt, and it would lead to an economic depression because of the scale of all that bad debt that's out there. You're saying that the Fed is trying to engineer getting some air out of the balloon, but it does not want the system to just crash to the ground. So at some point, and you said, and maybe it's around a 1.5% Fed funds rate, it's going to step in. And if the deflationary forces, really start raging, it's going to do everything it can, kitchen sink, et cetera, to try to prevent that from happening. I think that does open an interesting question about, can they be successful this time around? I don't necessarily want to rat hole into that, because we get really highly speculative at that point. But obviously, if you have a strong opinion, chime in on that. But let me get back to this question about sort of tactical things for real investors to be thinking about here. You were very generous in just sharing the position of your current portfolio. Quick reminder, that's short-term and long-term duration bonds. It's bond proxies like utilities, companies like Walmart. You're holding, for you, record amounts of gold and precious metal mining companies, and you're short the junk market. Now, when we've talked previously, you've said, hey, at some point in a big deflationary downdraft in the market, you want to shift like totally into the four horsemen.
Yes.
And
Good memory.
you're saying yes, so it sounds like you still think that way. Can you
Correct.
remind people what those four horsemen are, and can you say what are the indicators you're going to look at to say, okay, now is the time for me, Michael Pento, to get into these four horsemen in total?
Okay. So the four horsemen are cash, short duration bonds, the US dollar, and actual shorts in the stock market. I am actually short the stock market 10% right now. When would I sell everything else or most everything else? And what would be my cue to do that? Well, if you remember, why would I do that? Why would I, why wouldn't I sell? Why would I not hold GDX and some miners that I own? Why would I not hold that through the liquidity crisis? Well, because they don't work. I mean, gold miners are stocks, and everything goes to a correlation of one when the liquidity crisis hits. Everybody wants one thing. They want cash. They want dollars. The globe wants dollars. It's not just the shadow banking system and the banking system. Everybody wants dollars, and they sell what they can. And gold is one of those things, and certainly the miners are one of those things. So I expect that to happen again. It'll be a truncated collapse. So if you're not an actively managed portfolio like I am, I'm here every day going to work. I go to work every day and look at the credit markets. The most salient indicator that I will use is my model, the high frequency components of that model. And the top of the list of the high frequency components are the credit markets. And when I see them start to tighten, I'm not going to give away my model completely here, but when I will absolutely know when the credit markets are about to freeze over. And when that happens, when that spread between junk bonds and treasuries begins to blow out, according to what my model has dictated, the point of panic should be in the stock market, that is when I will head into those four horsemen of the apocalypse, which, by the way, this is where we started this interview. You don't have to be a victim of the worst bear market in history. It can actually be very beneficial for your portfolio if you know when to own those four horsemen. What to own and when is absolutely crucial. And if I've been doing this 32 years. I've been in this business for 32 years as a licensed professional. And it took me decades to perfect this model, and it didn't really officially launch until 2016. But if you haven't actively managed, and you have some great people that you work with, it doesn't have to be Pento portfolio strategies.
Yeah.
I don't know if he has a model, an actual algorithm that I have, but I have this algorithm, and it worked very well in 2020 in the first quarter. It worked very well this year. It should work, hopefully, God willing, very well in the next collapse, where you can actually protect and potentially profit. Can't guarantee it because it's illegal, and no one would do that if it has any scruples. But you have the potential to protect and actually profit from this great reconciliation of asset prices as long as the Fed lets it happen. And again, because of the new function of inflation, which is now way above, it's over 4 times their target level, the Fed put is much lower than it was at any other time since 1987. And that means the market could easily go down 30 to 50% before, Powell comes and says, hey, guess what? There's nothing else we can do but live with intractable and maybe hyperinflation. So here we go. I don't know why that person, I don't know why he ever went for another term. He's a billionaire. He had some success the way they define it as a
I was going to ask you that. Like, why? This guy knew probably better than almost anybody going in what he was going to be facing when he went up for renomination. And I don't know why anybody would sign up for such a, from my perspective, an unwinnable position.
I think I can answer that. I think I can answer that. When you have the hubris to believe that you know more than the market, when you have the arrogance to believe that you know the exact cost of money at all times, then you are arrogant enough to believe that you could hold that job, even faced with the most daunting task of landing a jet on an aircraft carrier the size of my driveway. And I have a decent sized driveway, by the way.
I get it, but it's not like he hadn't been spanked before. I mean, it just didn't sink in, I guess, right?
Paint dry, transitory, and maybe he'll resign and say, you know what, take it. Whoever's next, take it. Whoever's the vice chair at the time, take the position, because this is impossible. It's a no-win situation. He actually was at the helm of the Fed when they lost complete credibility. He'll have that disgrace of knowing he had the highest rate of inflation ever in reality. But even the way the Fed measures it and the Labor Department, BLS, Bureau of Labor Statistics, measures it, it's a division of Labor Department, highest inflation we've had in 40 years. That's his dubious legacy. And now he's going to have the legacy of destroying the stock market once again.
All right. So we're swinging punches here at Jerome Powell, and we think he deserves it. Maybe he doesn't. Who knows? But okay, Michael. So let's say Michael Pento is right. Market goes down another 30 to 50% from here. If I've been listening correctly to you, there is a point in that process where Powell is looking maybe not so much at the stock market pain, but looking at the wheels coming off the economy and saying, all right, I'm getting nervous that this whole thing could be going down now. And so I need to pivot. I'm going to go back to QE. I think you think it's going to be pretty prodigious in scope. Tell us what you think that would look like. And if you can put your investor hat on and say, okay, when we switch to that regime, if I'm going to get out of the four horsemen, where am I going to go into?
Yeah. Well, you have to have a different regime from deflation and recession depression, which is sector one of my investment spectrum. I have 5 spectrums of inflation and growth. That's sector one. That would be deflation and depression. Well, you can't stay in deflation if the Fed is going to monetize, with the help of the Treasury at the time, good buddy Janet Yellen, multiple $1 trillion of universal basic income. Hey, Adam, I told you, and I told the Fed and anyone else who would listen to me, all the way back to the Kudlow show in 2006. I said, if you want inflation, this is what you have to do. You give people money directly, you circumnavigate the banking system.
Right.
So,
and just for folks listening, because that is the fastest way to spike monetary velocity, to get that money flowing into the economy. A lot of what's been going on with the QT, with the QE, with the 200 billion a month and whatnot, a lot of that kind of built up in the banking system and didn't necessarily find its way out into the real economy. It certainly went into asset prices to a certain extent, but it didn't directly get into the economy. Whereas Michael was saying earlier, you give people direct checks, well, they go out and spend it. It immediately goes out there, immediately prices go up. So sorry, Michael, I just wanted to clarify that.
That's okay. You can interrupt me anytime you want. I do it myself sometimes, as you know. So Jim Rickards, I think, has it partially correct. I mean, Jim Rickards had his thesis is that QE isn't inflationary because you don't get that velocity. Well, he's partially right. QE is not inflationary when it comes to consumer price inflation. It's highly inflationary when it comes to asset prices. Because during QE, you create electronically, the Federal Reserve creates money out of thin air, and they buy an asset from a bank, one of the primary dealers. Well, if the primary dealers know that you're going to come and buy bonds, and in this last iteration of QE, they did, municipal bonds and junk bonds and corporate bonds and treasuries, of course, as they always do. If a bank knows that, they're going to take that money and they're not going to loan it to Wall Street. They're going to go out and buy more bonds. Wouldn't that make sense? They'll front run the Fed. So you have massive inflation in bonds. Prices go way up. The yields go way down. You got inflation in corporate bonds and junk bonds. You got inflation in the stock market. It's very inflationary for Wall Street. But the Fed, maybe they knew it the whole time. They play dumb very easily. Very easily, they play ignorant. They claim ignorance. But if you want to get inflation going, you do exactly what we did in COVID. You don't give QE just to banks. You directly monetize Treasury debt. You say, okay, Treasury, you send the checks out and I will buy bonds using the banks as a conduit, and the money goes directly to people, directly to businesses. And I think that's going to happen again. But the point, again, when we reach that epiphany, when we being the FOMC, when the government reaches that epiphany, they will be at least tacitly admitting, but I'll make a big I will promulgate this as loud as I can. They will tacitly admit to Wall Street, who will get it, the people who really understand macroeconomics will get the point. They cannot ever reduce their balance sheet. They cannot support the value of the dollar. They cannot provide consumers with stable prices. They cannot protect the purchasing power of those same individuals. And they cannot defend the purchasing power of sovereign debt. It's going to be known out there. I'll make a big stink of it. And if you're going to sit there with the four horsemen, when stagflation, like we've never seen before, is going to be the predominant macroeconomic condition, which is sector 5 of my spectrum, you're going to be in big trouble. So you have to be an active manager. You can't sit in a 60-40 portfolio because you're down double digits or a lot more, depending if you're Cathie Wood and if you've been massively long duration in the sovereign bond market. You're down 16% this year. If you're long Cathie Wood, I'm not going to quote her returns, but I think everybody knows it's not spectacular. What don't you want to own in this kind of market right now? High beta names. So you have sectors and style factors you need to avoid. People who own companies that have no earnings and all of it is in the future, and their cost of capital, these zombie companies that have to raise debt just to pay interest on existing debt, they're in a lot of hurt. And before we end up this interview, I just want to say one thing about that monetary cliff. If you look at the real Fed funds rate, because of that $200 billion average QE from March of 2020 to March of 2020, March of 2020 to March of 2022, the real Fed funds rate was profoundly negative. We can debate about where it was, but it's going from a negative, whatever, 1%, 2%, you could pick it, all the way up to 1 to 1.5%. That's a big move. When you add quantitative tightening to that, which I think QT is even more deflationary than raising the Fed funds rate, you're having the most hawkish Fed in history, other than possibly Paul Volcker, and we're going to have that's going to lead to the worst bear market that we've seen in our lifetime. And the Fed, China, Russia, nobody is going to be able to bail you out. Europe, neither. I mentioned Europe. They're not going to do it.
All right. Well, look, you've been incredibly generous in sharing your particular strategy for protecting against that process that you just laid out there, or protecting as best we can. I hate to wrap this up, Michael. We've gone about an hour and 20 minutes in the whole time here. I'd love to add 2 or 3 more hours on here. I'm sure a lot of our viewers would too, but I've got to be respectful of your time. So I guess as we wrap things up here, 2 questions for you. First, any parting bits of counsel to just the average prudent investor who's just looking to make it through, this future you're laying out for us here intact that you haven't already talked about?
Yeah, I mean, my minimum is $100,000. If you don't have $100,000, I can't take you as a client. It's in my ADV. I can't. Go to cash. People say, well, how could you recommend going to cash when you just said inflation is 8.5%? Well, that's illogical to me. If you have an investment account and you're determining, should I lose my principal by 30% and then start to subtract inflation? Or should I just subtract inflation and keep my principal intact? What would your answer be? What would be the logical conclusion? Go to cash. And going to cash for some time is not going to destroy your life. And it might be the smart thing to do in the next couple of years, or at least the next couple of quarters.
All right, and thank you for saying that. We've talked about hedge on this program a lot recently, both sort of as a smart, simple hedge like you're talking about there, and also the optionality that it gives you, that at some point in time, if indeed price is correct by the magnitude you're saying, well, then you can deploy it at much better valuations, right? So Michael, I'm glad you mentioned the fact that you have a registered investment advisory firm. For people that are interested in learning more about you, your work, your firm, where should they go?
So it's pentoport.com. And on that website, you'll see the midweek reality check, one of the navigation buttons. You can sign up for a free 5-week trial. If you like what you hear, for $50 a year, you can become a subscriber. And I'll give you my 36,000 foot interpretation as I do on your program. And if you want to have your money managed by a manager who isn't wedded to anything or any agenda other than making you money, then, and if you have 100,000, if you're a US citizen, I would gladly take you as a client. And instead of just putting you in some plug and play model based upon what my back office is pushing that day, or some kind of perma baloney that comes out of CNBC or the mainstream financial media of just buy and holding until things come back, because they don't always come back. And one more, can I just give you one more data point before we wrap this up?
For you, yes.
One more data point. I always hear on CNBC, people say inflation is great for stocks. Stocks are a great hedge against inflation. Well, from the nadir of inflation in 1972, all the way till it peaked in 1980, the stock market lost 7% of its value. Inflation is not a good hedge when you have inflation running this hot. So don't believe CNBC, listen to Adam Taggart, put your money in someone like Lance Roberts, who actively manages your money, or I think you have another outfit called New Harbor, doesn't have to be Pento, but get your mind out of the buy and hold 60-40 portfolio as fast as you can, because your time is running out fast.
All right, Michael. Well, look, I'm going to have to leave it there. Thank you so much again for just delivering, the unvarnished truth as best you see it to the average investor here. That's the whole reason why we've created Wealthion. So it is no surprise to me, and I think that most of our viewers here, Michael, why you're one of the most frequently recommended guests on this program. And I hope we can have you back again many times as the progression plays out here, so that you can keep kind of calling audibles, as the situation on the ground evolves as we move from here. But Michael, just want to say thank you so much. It's always such an honor and a pleasure to get to interview you, buddy. Love to have you back on this program again soon.
Again, the privilege is all mine. I want to wish our audience a happy Passover and a blessed Easter. God bless.
All right, well, now's the time on the program where we bring in Wealthion's endorsed financial advisors to both react to what Michael Pento just said and talk about what the markets have done since last week. I'm joined as usual by the lead partners from New Harbor Financial, John Lodra and Mike Preston. Guys, thanks so much for joining us. Phenomenal discussion there with Michael. Mike Preston, why don't we start with you? What did you take away from the discussion?
Really enjoyed that with Michael Pento, Adam. Thank you. Always, we've been a big admirer of his work, his money management track record, and his book and his appearances in the public eye. So it's a pleasure to see him talk today. Michael talks about how he's bearish. He was bearish in the beginning part of this year. He said that's been somewhat delayed with, or maybe it was delayed slightly because of the Russian invasion of Ukraine, but still he's very bearish on the remainder of the year. And he says it's because of a record change in fiscal and monetary policy. Absolutely right. I mean, the government has stopped, or there's been a big change. There was a spending spree of $6 trillion back in 2020, or in the follow-on effect of COVID. And that, when you hand money to people, like he says, to go out and spend and tell them that they really can't get outside and produce, all they can do is spend. Obviously, it's going to be stimulative to the economy, but that's all ended in rolling off. And at the same time, quantitative easing, or the monetary cliff, is approaching. And I guess quantitative easing did get as high as $200 billion a month, like you said, but that's all ending. And the net effect of all of that is $1 trillion of base money supply is going to be shrinking going forward or rolling off the balance sheet. That's a huge negative. And at a time where valuations are at what many believe is a permanently high plateau, and believe me, we're not at a permanently high plateau. You know, that's a word that I think that was Fisher that might have said that back in the Great Depression time. But valuations are far beyond anything that we've ever seen before and have stayed there for a very, very long time. So you know, he's bearish and we're bearish, and we're very concerned about valuations in this market, particularly at a time where we're starting to see inflation. Everyone's talking about inflation. The official number was somewhere around 8%. It's probably higher than that, a lot of people believe. And as Michael points out, there's some political pressure now to get inflation down or to break the back of inflation. Michael speculates that it's the constituents that are going to vote in November that are putting pressure on, on their elected leaders, and so on and so forth. And so that our president is probably putting pressure on Jay Powell to get inflation under control, and he probably takes that into consideration. He probably takes that very seriously. So the upshot of all of that is the Fed put, or the price in which the price of the market in which the Fed will come in and reverse course this time, like they did in 2018, is probably much lower than most people believe, 30 to 50% below, Michael Pento says. And we would have to agree. Frankly, we think there's much more downside in this market than even that. So the message remains the same: to be careful, to reduce risk and or hedge risk. There's a lot of different ways to do that. So overall, it was a great talk.
All right. Yeah. As he was talking, I could hear you guys making mental notes, because I think it's simpatico with a lot of the way you guys think. John, I'll let you chime onto that with whatever you like, but a question. So we talk about the turning off of those stimulus spigots, and since the coronavirus hit, it was $6 trillion in fiscal stimulus, about $4 trillion in monetary stimulus. That's 10 plus trillion. That's now stopped, right? And Congress isn't passing new fiscal stimulus right now. It's gridlocked there, and the Fed has said, "Hey, we're actually not even just not releasing stimulus. We're now tightening. We're going to start draining the pool." You add to that the huge inflation that we have. We just found out that the latest numbers for March were 8.5% inflation, over a 40-year high. That obviously eats into profit margins. It crimps consumer spending. It eats into profit margins of these companies. There's just sort of, I use that term parade of horribles here, and yet the S&P is only down 7% this year. And it kind of seems like it hasn't gotten the memo, that the gravy train has left the station and isn't coming back. So my question for you is, are we sort of in this Wile E. Coyote moment where the market has gone off the cliff, but it hasn't quite realized yet that fact, and the pull of gravity just hasn't quite set in, but it's obviously going to. Is that a good analogy to where we are right now in the markets in your eye?
Yeah, Adam, I don't have much to add to what Mike just said. I thought it was a really good synopsis. But yeah, I think that Wile E. Coyote moment is a very apt description, because, look, even going into the COVID pandemic, markets were already crazily overvalued by any reliable historic metric going back to, nearly 100 years ago. So what has happened since then, fueled by the kind of stimulus and the fiscal and monetary interventions that we've seen in the wake of COVID, has brought things to a whole nother level of silly. So to think that a 7% retreat or thereabouts from all-time highs, extreme highs in valuations, is pricing in anywhere close to likely resetting of prices as a result of a regime change in monetary policy, it would be very, very illogical to make that assumption. So yeah, the image of a midair floating over a cliff is very apt. I really like that Michael spoke of the difference between what likely is going to be the pace of quantitative tightening in these next upcoming months to really wrestle with inflation, and comparing that to, say, the 2017, 2018 period there. The pace at which, in 3 months, we're likely going to see a pace of tightening to the tune of, 95 billion, a month, which is, a trillion annualized. That's some big reversal of the pace of of what's been done, and certainly puts in pay, what was done in the 17-18 timeframe pales in comparison to that pace. So this is a real shock that the system has not seen anytime, literally, since the housing crisis, and these emergency measures have, were unleashed to begin with. So yeah, I think the market's not even close to pricing all that in.
All right. So of course the big question is, all right, well, what do we do about all this, right? And Michael shared his existing portfolio allocation with us, and then he and I talked about, okay, and when do you go to the four horsemen, right? Like when the real storm hits and you're just trying not to lose, capital, where do you go? And what I took from Michael was, he said, we're not quite at that stage yet where the kind of house of cards comes tumbling, but we're going to go through disinflation beforehand. And his portfolio for disinflation was short and long-term duration bonds, and mostly talking about treasuries here. He's got a record amount of gold and exposure to the precious metal miners, which I'm sure was music to your guys' ears, because that, I think, is your largest long position in your fund, if I'm not mistaken. He says in addition to those bonds, he has some bond proxies like utilities and Walmart. And then he is beginning to start a short component to his portfolio. Sounds like right now he's starting with shorting the junk bond market. So Mike, why don't we start with you? What's your guys' reaction to an allocation like that right now?
We agree with a lot of it. I mean, a lot of it makes sense. The short and long duration bonds, I think that echoes our thinking in quite a large way, in that we hold a lot of cash. And frankly, we just replaced a T-bill yesterday, Treasury Bill. And this was a 4-month Treasury Bill, I think. And it yielded 0.75% annualized, 0.74% maybe, to be exact, which unheard of not long ago. Even last year, we were having trouble just getting the same money back that we invested. That's a 0% return. Many Treasury bills were trading at negative yields. So it's been a huge change in the short end of the curve. The Treasury curve inverted briefly. I think it was last week or the week before. It has since kind of corrected and uninverted. But the short side of things, I'm pointing out, just for example, is that we're up to about 0.75% for 4-month paper, high quality paper. And it's easy to get above 1% to go out just a little bit further. In fact, 2-year Treasury notes are trading at around 2.5% or so. And that's another position that we put into our cash section of our portfolio. So yeah, the short end of the curve is very attractive. There's not a lot of extra juice, in our opinion, to try to buy corporates or high yield bonds when you can get high quality treasuries on the short end, close to a point to above 2 points, and not even have to go beyond 2 years. That's very attractive. And that's where the vast majority of our cash holdings are right now. At the same time, we added long-term treasury bonds. We added 20+ year bonds as well a couple of weeks ago. We hedged it. I'm glad we did, because we were a little bit early. We hedged it with a short call, but we would like to hold that position and maybe even add to it a little bit if we get further weakness, because we think at some point here, long-term treasuries are going to bounce. And the inverse of that, yields are short-term overdone. They recently went through 250, I think, 2.50 on the 10-year, went even higher than that. I'm just looking at where they closed today. They closed at about 270. They got as high as 280, it looks like, recently. So yeah, we think they might have overshot a little bit to the upside, which is why we're building a position in long-term bonds with a hedge, as I pointed out. He also mentions physical gold and miners. Yeah, that was music to our ears. We say it almost every week here. We love gold. We think it's likely to go to 2,500 over the next year. That would mean miners using GDX as a proxy would be maybe mid 50s. GDX closed above 40 today, almost 41. So it frankly doesn't look like that move is done yet. And all of this is happening while the dollar's getting stronger. The dollar's getting stronger, and the dollar index went through 100 yesterday, closed just below it today. He also mentions bond proxies and short the junk bond market. I don't think we have much of an opinion on short bond proxies. I think he mentioned Walmart and utilities. Utilities have been doing very well. and that's even with interest rates going up. But we're a little cautious on them, and that's not an area that we're in. I'm not saying it's wrong. It's just not something that we're focused on right now. And lastly, shorting the junk bond market probably should work. Honestly, from a mathematical perspective, it absolutely should work, as should shorting the broad stock market, the S&P. But it's incredibly hard to do so. And we're not short any of those things, although, again, mathematically, I think it probably makes sense. And I admire Michael for finding a way to put that in the portfolio that makes sense for him and his clients. But it's not something that we've done yet. Our approach has been to hold high quality cash and then deploy it later. But there's a high degree of alignment with what he mentioned and what he's doing and what we're doing.
Great. And John, I'm coming to you to let you add any color to that. But a couple of things that Mike Preston here just mentioned. One, that you guys are holding a fair amount of cash right now, which I think Michael Pento would say, hey, that's probably a wise move leading up to, the four horsemen period here. But as Mike Preston just said, the dollar index is extremely close to 100 now. It's had a strong rise since the beginning of the year, gone up from about 96 to now just about 100. And it hasn't been at the 100 level for a long time. It kind of briefly hit it back in 2017, I think March of 2017. And then you got to go all the way back to February 2003 before you see the index back at that level. So I'd love for you to comment on just sort of what the significance of this strength in the dollar might be. Well, let's do that. And then I want to ask you a question about junk bonds, but why don't we start with the dollar commentary?
Yeah, those stats you just talked about there, Adam, are right. If you look at, and you can look at the dollar strength in many different ways. One is the dollar index, which is a basket of, the index of the US dollar relative to a global basket of currencies. That is right around the 100 mark, right, in the index. And it's touched that point and maybe, poked above it, handful of times, three-ish, four times over the last, 4 or 5 years. But yeah, then you got to go back all the way to 2002, 2003 to see a similar period. And again, the really interesting thing here about that is how strong commodities and things like precious metals have been. Typically, those often have an inverse relationship when the dollar is strong. Sometimes the commodity space is weaker, relatively speaking, and vice versa. So that's a really interesting divergence, and I think it speaks to kind of the U.S. dollar still is the kind of reserve currency of the world, and it's a flight to safety kind of thing, and liquidity preferences of scared folks. I know you've had gentlemen from Santiago Capital talk about the dollar milkshake theory on your
Brent
program.
Johnson, yeah.
Yeah, so yeah, Brett's talked about that a lot in your program. So these are all things that are very complex in a chess game of global economies and geopolitics, but it's a notable thing that there's this divergence between a very, very strong commodities space, including precious metals and the dollar index.
All right, great. And for folks that aren't familiar with what the dollar milkshake theory is, go watch that interview that we did with Brent Johnson that John just referenced. I'll put up a link to it right here. It's a very important concept, especially as trouble begins to hit the global financial markets, because it basically predicts why the US dollar may strengthen a lot more than many people expect right now. And there's some pretty good mathematical reasons for that. So John, you mentioned that commodities have been surprisingly strong, coincident with the dollar strength. And that's surprising, as you mentioned, because they have a general inverse relationship. But in uncertain and times of transition, you can have a lot of long-standing relationships that are more correlated versus causal begin to break. And the danger for investors is if you're just kind of going with the old rule of thumb, it may not apply anymore going forward. So you might be kind of, making your decisions based upon those old saws, that old sort of, conventional wisdom. It might be working against you because it may not apply in the new world. And Charles Hugh Smith, who you guys have seen me interact with many times over the years, he's written several pieces over the years of calling for instances where gold and the dollar will strengthen together, because there really is no reason that they can't. People think of them as inversely related, kind of a seesaw relationship, but it's really doesn't have to be that way at all. And certainly in times of uncertainty, people are looking for safe haven. And obviously, for a lot of the reasons we just mentioned about the dollar milkshake theory and others, the US dollar will strengthen that period, but also capital will flow into precious metals markets and whatnot too. And we're beginning to see that right now, right? And interestingly, as the dollar has increased strongly this week versus other fiat currencies, it's actually fallen versus gold because gold has appreciated in dollars this week. I want to end on gold, guys, but real quickly, just back to junk bonds for a second. I personally, I think that there's some good opportunity there where, mathematically, as yields go up, bond prices have to come down, right? That is a mathematical relationship, right? And with the Fed coming out and saying, look, we're super serious, right? We are going to go and we're going to increase the cost of capital. We're going to do at least 6+ more rate hikes, left this year. It's a pretty easy bet at this time that until at such point in time the Fed changes its mind and pivots, the cost of capital is going to go up and yields are going to have to go up to compensate for that. So bond prices should come down, and high yield bonds, or otherwise known as junk bonds, well, those are the most vulnerable to this trend, right? Those are the riskiest companies, the ones with the least amount of profitability, the highest potential for default. So they should be the canary in the coal mine. They should be the ones falling first and falling farthest. And they've moved somewhat since the start of this year downwards, but they haven't really moved all that much. So where I'm going with this, and Mike, maybe I'll go back to you first, and John, feel free to chime in. Is this becoming more of an attractive play in your guys' eyes? I know, Mike, you said you haven't taken that step yet, but is this a tactic that you think, may be worthy of some of the investors watching the show to at least consider?
I think it could be worth considering, and I assume that you're talking about shorting them, like Michael talked about there, and not buying them.
Absolutely. Sorry
Yeah.
if I weren't clear on that. I was talking about shorting junk bonds. Yes.
Yeah, that's what I thought you meant.
Expecting them to fall in price. So
you could just take a look at one of the large ETFs. If you want to take a look at the whole index, you can take a look at JNK or HYG. Just put that into a chart package and take a look. I just happen to be looking at JNK right now. It's down around 7%. Lo and behold, it's down around 7% year to date. Very similar to the S&P. High yield or junk bonds trade very much like stocks because they are totally beholden to the cost of capital, and they're closer to default than any of the rest of the market. So yeah, I certainly wouldn't be buying them here, particularly with their spread or the spread above the risk-free rate being very near all-time lows. You're not getting a lot of juice or extra oomph for the risk that you're taking, and yet we still see prospects from that we talked to here quite a few times having junk bond funds in their portfolio because it's very popular to have those in an asset allocation type program. So if you have junk bond exposure through mutual funds in a passively allocated portfolio, the first thing you could do is sell that fund. You don't even have to go short it. You could simply just start by selling it. But yes, I do think that there would be opportunities to short this market. I would warn that I would do it only if you were very sophisticated and able to take the risk. The problem with shorting an asset like that is that when you short an asset, you have to borrow it and then sell it. So you borrow it, sell it, and replace it later. And while you're short that asset, you also have to pay the dividend, or you owe the dividend every time it pays. And the current dividend is almost 5%. It looks like 4.75% on that ETF right now. So you're paying out minus 4.75% income while you're borrowing it, while at the same time you're shorted. And then of course you have to be right about the direction. With mathematically, I think that it makes sense, but this market is anything but predictable. And it wouldn't surprise me if the equity markets did have one more melt up, like your frequent guest, David Hunter, has often said. And if that happens, junk bonds will also have one more melt up. So that's a long answer. I think ultimately the right direction is down. But it's pretty hard to do. It's pretty hard to do.
All right, good answer. Those are good caveats. I'm glad you brought them up. You're underscoring the importance of why we recommend folks work with experienced advisors if they haven't done this a lot themselves. David Hunter, by the way, we'll be interviewing him next week, so we'll have a chance to ask him directly his thoughts about this. All right, so last topic, guys, just gold. We talk about it a lot. As I mentioned earlier, it had a good week. The miners have done particularly well, though. They have gone from about 38 or so at the beginning of the week. I'm talking about the GDX ETF here. It's now above 40. I think it's about $40.70. David Hunter, to bring him up again, he's been mentioning for months that his target's 50 on it. Mike Preston, I think I've heard you use that target as well. Are we just kind of on track here in terms of things going to plan according to your guys' expectations? John, I'll let you answer this, then we'll wrap it up.
Yeah, I think we are, Adam. We think we are, and I think actually David Hunter's forecast is 60 on GDX, if I'm not mistaken. But
if it is, he's raised it then, but he sure could have.
I may be wrong there, but all to say is that there's likely significant upside. But I want to call out something that Michael Pento just talked about, and this is something we're very cognizant about, as structurally sound and bullish as we are about the gold mining space and precious metals still, even with their move higher. In a real panic risk off scenario, everything gets sold. And to your point, Adam, about not just taking for granted the historical relationships. In theory, precious metals move inversely with the stock market and this and that. But in a real risk-off scenario, and we saw it, for example, in March of 2020, everything gets sold, even the things that deserve to be held. So we could see a very big move down just in sympathy in things like precious metal mining stocks, because they're stocks, and folks got to sell things to free up cash for margin calls and all these things. And that's why we, as bullish as we are, we have been fairly consistent hedging these positions. With hedges, we use options quite prolifically to build in hedges, and we'll probably continue to do so. And at some point, we'll probably be trimming back our exposure there, not necessarily all the way, but trimming back some of the gains we've gotten, all to manage position sizes and things like that. There's no guarantee of path higher ahead, but there's certainly a lot of factors that could support that.
All right, well, good, all good to underscore. I want to point out that we've been talking about miners a lot in this program. We were talking about them last year at times when they were down in the 20s, and now we're here up in the 40s, which is just sort of I want to give you guys a little bit of a victory lap for having been a champion of this space. And I do appreciate the reminder there, John, about the importance of hedges and folks. Yeah, as we get to that period that Michael Pento was talking about, where you need to be in the four horsemen because kind of everything's going to hell in a handbasket together. That's where hedges really have their true moment in the sun, where what they do is they provide insurance for your portfolio, and they kind of act like circuit breakers, right? Like if we get into a market meltdown scenario, like we did in the spring of early 2020, right, when the pandemic hit, the market basically lost 35% or so in a matter of like 2.5 weeks. There were days when the market was down 10%, and most investors were just caught flat-footed by that, and they froze like deer in the headlights, and they lost a lot of money in a very short period of time. What the hedges do is the hedges are almost like automatic circuit breakers that get you out of your positions, at some predetermined level, so that you're not riding that elevator all the way down, right? That you're preserving a lot of what you had gained along the way. If it's done right. I say this every week, so I won't go deep on it now, but that's a huge reason why we recommend people work, especially during a time of such great uncertainty like right now, with an experienced professional financial advisor who gets all the risks that we talked about with Michael Pento, but also understands the mechanics of the tools for risk management that we're talking about right here. If you want to learn more about that, set up a free consultation with our advisors, including John and Mike here at New Harbor. Just stick around to the end of the video. It's coming up in just a few seconds. We tell you how to set up one of those absolutely free consultations. And wrapping up here, guys, one thing I want to let everybody know about is I just got put on my radar a great event that's coming up. It's got over 50 of some of the absolute highest quality financial experts that I've ever seen brought together for a single event. It's got several people that have appeared on this channel before, whom we all like and respect, but it has a ton more people that I've not yet been able to attract in our orbit. And like I said, this is one of the best aggregations of economic and financial minds that I've yet seen in a single event. This is at John Malden's Strategic Investment Conference. And if you just go to wealthion.com/SIC, you can see all the details there, but I just got briefed on it by that team. Right now, if people sign up, you get a massive discount. I think it's like 44% or something like that. So go check it out, see if it's something you're interested in. But I'm probably going to be getting involved in that. In fact, I'm definitely going to be getting involved in that now that I've been briefed on it. And I wanted to flag it for all of you viewers, because I know people enjoy, not only learning from great minds like that, but there's apparently a number of interactive opportunities too, where you can ask your questions directly of these people during the live events and stuff like that. All right, guys, in wrapping up here, John, I'm going to give you the last word here, because you guys talk to people week in, week out, and Mike, feel free to chime in too. But you guys have your finger on the pulse of what today's investors are thinking about, hopes, dreams, worries, etc. Any bit of parting advice based upon the discussions you've been having over the past week with the people that have been calling into you?
Well, folks are obviously concerned about what's going on in the world. It doesn't take too far a glance at headlines, and they see the volatility in markets, even just in kind of broad broadcasts on the nightly news and whatnot. But generally speaking, I think our clients have been pretty at ease in that, with our defensive positioning, their accounts have been pretty stable and actually kind of bucking the trend in many cases. So we're happy about that, and our clients, I think, can rest a little bit easier. I'll let Mike kind of share a little bit of the perspective of, we're fortunate to have lots of conversations with prospective clients, which is a different kind of conversation than the ones we have with our longtime clients. So I'll hand over to Mike to give some thoughts there.
Yeah, I mean, it's like this bubble or this overvalued market's been going on so long that I'd say most of the people in the last few months have been relatively conservatively postured, before they came to us, or a common question is, I've got a high amount of cash in my account, but I just don't know how to get back in. What should I do to get back in? And these aren't people that have necessarily been out since 2008. I'm talking about people that maybe got out last year thinking, boy, well, this thing is really long in the tooth, or the year before. And of course, it's only kind of, it had a blow off, and it went higher and reached a high near the end of 21 or early 22. And now it's down 7% for the year. But like John said, it's nothing. It's a tiny little speck compared to how egregiously overvalued this market is. And so people want to have a plan for how to get back in. And I think we give them some guidance on that. And my guidance right now would be, don't be in a rush to get back in. If history's any guide, and it should be, we probably will have a very big bear market. Jim Rogers was on not too long ago with you, Adam, and we were there too. And he said, I expect the largest bear market in my lifetime. And we think he's probably right.
Yeah, and just to interrupt you here, but Michael Pento said pretty much the same thing. He said, we're going to see the biggest bear market that any of us have lived through.
You're correct. He did say that. That's right. So don't be in a rush. Take your time. Don't fret about it. You're not going to have to hop on the next V-shaped bottom, in our view. And even if it is a V-shaped bottom, we think that fair valuation is quite a bit below here. We can offer some guidance, and we offer a system on how to get in. We know how to use options. We can sell premium to hedge a kind of a systems-based entry into the market. And so we can offer that. And I think that people want to understand how to do that. But my short answer is just don't be in a rush. And, we'll be talking every week about what we're doing and what we think. So just continue tuning in to programs like this.
All right. Wise counsel, guys. All right. Thanks so much. All right, everybody watching, if you enjoyed this interview with Michael Pento, if you'd like to see more great guests like him on the program, please just support this channel by hitting the like button and then clicking the subscribe button below, as well as that little bell icon right next to it. And if you have any interest, again, go to wealthion.com/SIC to learn more about that strategic investment conference lineup. John and Mike, thanks so much for taking another week to clarify and advance the understanding of all of our Wealthion viewers here. Everybody else, thanks so much for watching. See you guys next week.
It was a great pleasure. Thanks, Adam.
Thanks, Adam. See you next week. Thanks.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.